Today I'm going to be talking about qualified small business corporations. Sometimes tax attorneys refer to these as Section 1202 companies after the Internal Revenue Code section upon which it was formed. My name is Rich Hofmann. I'm with Neil Jesani Advisors. I've worked with Neil Jesani for about 3 years. Prior to that, I've got 25 years of experience as a tax attorney and significantly more than that as a CPA. So Section 1202, Qualified Small Business Corporations, sometimes seems simpler than it really is. To qualify as a small business corporation, you must be formed as a C corporation and your assets must be less than $75 million. Now, on its face, it would seem that any company could qualify. There are carve-outs. Carve-outs include any business that relies on the reputation of its owner. So, example, lawyers, accountants, doctors, things like that are carved out, and those businesses cannot be qualified small business corporation. Why might you want to be a qualified small business corporation? Well, this is the benefit. When you ultimately sell the stock, you can exclude the gain on the sale of the stock up to $15 million or 10 times your investment amount. So if you invested $5 million, you could exclude up to $50 million of gain on the sale of the company. The amount that you are permitted to exclude depends on how long you have held the stock. If you have held it longer than 5 years and the stock was issued after the One Big Beautiful Bill in July 2025, then the exclusion amount is the greater of 10 times your basis or $15 million. If you've held it for a shorter period of time, the amount of exclusion comes down. So if you've held it for 4 years, you can exclude 80%, and 3 years, 50% of that 15 million or 10 times basis exclusion amount. So your holding period determines how much of that gain you can exclude. So how much gain can you exclude when you sell? It depends on a handful of things. If your company was formed after the One Big Beautiful Bill, you can exclude up to $15 million of gain or 10 times your investment, whichever is larger. If your investment was before the Big Beautiful Bill in 2025, then the exclusion amount is the greater of 10 times your investment or $10 million. Now, your holding period after the One Big Beautiful Bill, if you hold it for 5 years, you get 100% of that. So the greater of $15 million or 10 times your investment. If you've held it for 4 years at the time of the sale, then the exclusion amount is 75%. And if you've held it for 3 years, then it is 50%. Under 3 years, there is no gain exclusion. So the real benefit of having a qualified small business corporation is on the sale. So you've watched this video to this point and you think, gosh, it's pretty easy to be a qualified small business corporation. There are some nuances that make it a little bit more difficult. And one of those nuances is that you have to use 80% of your capital in the business. Now, what does that mean? It prevents C corporations from making a lot of money and holding it as an investment. So 80% of the money you've put into that company has to be used in the business. Now, you can acquire other businesses with that money, and that will count as that active participation. The key here is engaging a CPA, accountant, tax attorney that understands these rules and can look over your shoulder while you're conducting business to make sure you don't run afoul of those rules, because a foot fault, you've got too much invested in the market and now you fall under that 80%, could result in you losing the benefit of being a qualified small business corporation. So you formed your company and it's not a C corporation, and you think, gosh, if only I'd figured this out, I could be a qualified small business corporation and exclude some of the gain when I sell the company. It's not too late. There are ways to restructure your business to become a C corporation and qualify for that qualified small business corporation gain exclusion. Those types of reorganizations really need somebody who is an expert in the law to guide you through to make sure that you qualify. because you do run the risk, if you don't do it correctly, that you are not a qualified small business company. You're just churning money doing a corporate reorganization that's going to yield you no benefits. The other piece is that when you do it, you still have to be a C corporation for 5 years to get that benefit. So you can't change right before the sale and get that benefit. You've got to do it well in advance. So you've decided you want to be a qualified small business corporation. Either you're forming a business and you know you want to exit through sale and you think a C corporation may be the way to go, or you've got an existing business and you think converting now may be ideal for you. The key thing for you is to engage a competent advisor to help you through the process. If you're interested in engaging Neil Jesani Advisors, you can find the link in the description to this video.